Barbara, and let me come to you specifically on the consumer, because it's so much at the heart of our economy. We talked this week with the chair and CEO of Bank of America, Brian Moynihan, who said he's looking at the consumer from where he sits. He has a lot of access in the consumer data. He says it's really very strong, and that will take us through the tightening that we're looking for from the Fed. Do you agree?
So I think what Brian was talking about was what he was seeing currently. And this week, the market got excited about housing starts. I think those are lagging indicators, and you can't create alpha if you're driving with the rear view mirror. If you look at house sales, to me, that's far more indicative of what is going on. And the S&P Home Builder Index wouldn't be down 28% this year if we didn't have a problem. National home sales have been down in 3 of the 4 last months. So the consumer is not feeling as good as they did this time last year. And if we just want to look at sales and retail sales, 2021 is an uncomparable year. That was peak retail sales. Retail sales were up 17.2% in 2021. So every company is facing really tough comps. And I think the street is extrapolating the strength of the consumer in 2021, and it's not going to happen. So I look at companies that look like they're on 10 times earnings, but on a normalized earnings number, they're more like 30 times. And I can give you multiple examples of that. So just tactfully right now, given where estimates are, we are very short discretionary consumer.
So give us a couple of examples. What do you run toward in that world, Barbara, and what do you run away from?
Okay, so let's look at Tesla. They had a great quarter this week. And I would say that's a big one. Good. They've got purchasing power, but that to me is not indicative of what's going on in the auto market. If you look at a CarMax or a Carvana or an auto lead this morning, they've had a terrible time. And so you look at something like CarMax, and 50% of their profits are from auto sales. So that's a function of commission and volume. Last year, they sold 11.7 million cars. In the great financial crisis, they sold 9.5. A normalized number is 10.5. So I don't think they're going to do 11.7 million car sales this year. The other 50% of their earnings are from financing, and that's a function of spreads and loan loss provisions, both of which are below a normalized number. So on my math, the CarMax was over-earning by 10% on the top line, and it was over-earning by 20% in finance. And so that's 30% over-earning. So on an EPS of $5 and a 15 times multiple, I get a 75 target, and the stock's at 90 today. So this is what I mean about uncomparable comps and unrealistic expectations.
So, Rick, where are you on the consumer right now? Because it's so important. I mean, when we talk to people like Secretary Yellen, she points to the strength in the job market. Is that going to get us through?
So I think it's more complex. I think what Barbara said around the housing market. Housing market's going through a stagflationary dynamic. There's an affordability problem that is profound. You're seeing mortgage applications drop as a result of that. Home builders, as she was saying, is definitely down. Completely agree with that. I think you're going to see consumption slowing. You are seeing that because of this dynamic around where fuel prices are, where food prices are. So you are seeing some pullback from the consumer. But I think it's much more complex around, quite frankly, in my career, I've never seen a consumer more loaded for bear than they are today. Just to give you some of the stats. There's $2.5 trillion of savings that the consumer still has. We track this number really closely. $2.5 trillion is still of savings from the fiscal stimulus. You also, as you said, you have a job market that is arguably white hot, and consumers tend to spend based on their. And you're seeing, by the way, the quits rate is really high, and that's when individuals are confident in their job prospects, and the consumer has delevered. And actually looked at something today that for the first time in 30 years, cash on hand is higher than debt for consumers. That is a pretty extraordinary. That's generational change. So I think Barbara's right around the consumer can wait and be patient, and when it sees prices that are extremely high, and you compare them to where they were, what consumption was last year before these prices were high, I do think you'll see some pullback of that. But I'm pretty far from this as a recessionary construct when you've got this sort of firepower. By the way, sitting on corporate balance sheets as well, you've got that sort of firepower. So I'm a bit more enthusiastic about the consumer can be in good shape and be supportive, but agree with the fact they can be patient and pull back when you see the prices of food escalate so quickly, which they will continue to do.
Barbara, is the household balance sheet going to protect us from a recession?
I hear what Rick's saying, but when you look at that $2.5 trillion and you just look at just what rates have done on a 30-year mortgage for the average new homeowner. The average mortgage expense is $500 more per month. That's $6,000 a year. You add that to higher gas prices, higher rent, higher food, and you can see how you can blow through that $2.5 trillion in extra savings pretty quickly. I just, Rick, I agree that consumers in better shape than perhaps they were when they had more debt. But I also think the cost of living is just so much higher today that when real weekly average earnings are down and retail sales are down, right? That combination of lower spending and lower earnings over the last 60 years has always meant you're heading into a recession. And that's where we are. Both of those figures are negative. For average weekly earnings, the number's down negative 3.3% year on year, and retail sales are now negative 1.6% year on year. So that tells you the consumer isn't feeling healthy. And in addition to that, they no longer have those stimulus checks. So does the consumer have more money? No, I don't think they do. It's not incoming anyway.
Rick, one last point, briefly, if we can. We haven't talked at all about China and the shutdown in China. Is that going to have a substantial effect on our economy?
China is almost 20% of the global economy. When you create a dynamic of a shutdown, not only does it impact the economy in terms of consumption in China and the effect that has on the global economy, particularly things like commodities, et cetera, building products, et cetera, it is pretty significant. And then when you talk about supply chain shutdown, how big multinational companies have to deal with a shutdown of that, it will have an impact. And listen, the thing I think you have to put into perspective with that is the fact that China's putting in a tremendous amount of monetary stimulus. By the way, look at the last 3 days, what's happened to their currency. They're letting their currency weaken. They've been very clear about the triple R in terms of how they're going to be accommodated from that perspective. And there was a 24-point plan they put in place. So China's pretty extraordinary in their ability to address these issues. But in the near term, it's a slowdown. And it has global ramifications in a multifaceted way.